The biggest bank collapse since 2008 just happened.
When banks experience financial losses, it is and should be a matter of concern.
Silicon Valley Bank was just ordered to shut down and is likely going bankrupt. The financial markets are absolutely freaking out, but the question is, was this an isolated incident? Or will this financial contagion spread to other tier 1 banks like JP Morgan, Goldman Sachs, and Wells Fargo? And most importantly, what's gonna happen to real estate? Is this a 2008 2.0 all over again? So the collapse of Silicon Valley Bank on Friday is still being worked out. We don't have all of the details just yet, but essentially in 2021, SVB doubled the amount of treasuries, bonds, that they had on their books, averaging around the 2% mark on average. Now, this is nothing new because most of the big banks buy US treasuries because it's a safe bet as you're betting on America. And I don't know if you've noticed, but it's pretty much impossible for America to go bankrupt because every time we get close to that budget being tested and America going bankrupt, they seem to always up the deficit budget, so we never actually reach that point. So it's pretty much impossible. But that's another problem for another video. But all of those bonds that SVB bought around 2%, those bonds are now around 5%, showing a massive unrealized loss on their books. Now, this isn't really that big of a deal because if you just hold the bonds until maturity, you get your principal back and you don't lose any money. So it's not really that big of a deal. The real problem is when investors were looking at SVB's books and saw this massive unrealized loss, coupled with the fact that the Fed just raised interest rates to an historic unprecedented amount and speed, which is really hurting the tech industry, which is SVB's primary focus is lending to tech startups, which the tech industry and especially tech startups are just getting smashed right now from all of these interest rate hikes. So let's break this down real quick and pretend that you're an investor to this bank. You've lent this bank money to invest in tech startups, which is what they specialize in. And all of those tech companies, or the majority of these tech startups, are probably not gonna make it out alive with this new interest rate hike cycle, with how expensive money is, and their business is crumbling. They can't hire anybody anymore. They're firing people. They're not selling as many products and services because of the fear of recession, coupled with the fact of that massive unrealized loss of bonds. And this is the entire problem. See, a bank of this size can normally float that unrealized loss from moving money from A to B and doing all these tricky things that banks do. It's not really that crazy. But if for some reason every person at that bank wanted to take their money out of the bank and now they could no longer move money around to protect this floating unrealized loss, they would be forced to sell assets in order to come up with that money to pay back their investors and lenders. And well, with their stock dropping 60% on Friday alone, selling stock is really no longer an option to recoup some of that capital. So this really only leads to the option of selling those bonds, which are massively at an unrealized loss if they were to sell. But like I said, if everybody's taking their money out of the bank, that's really no longer an option either. And there, in a nutshell, is why this particular bank failed and why it was forced to close. So with all of that being said, the real question if you're on this channel is, how is this gonna affect the real estate market? So let's break this down one by one. Number one, will this spread to other tier 1 banks? Now, banks like JP Morgan, Wells Fargo, Goldman Sachs, etc., these big banks go under so much more scrutiny than SVB did since the 2008 recession because we don't want a repeat of that. So their books look a lot different. So at this point anyway, it's unlikely that this is gonna spread to those type of banks. Also, these bigger banks have a much more diversified book, whereas they're lending on real estate, other types of second mortgages and refinances, stocks, bonds, etc., not just startup tech companies, which is really the most risky asset of all. So again, at this point, only days after SVB went under, it's unlikely that this contagion is gonna spread to all of the other major banks. Number two, will this actually affect real estate prices? Now, the only way this kind of thing would really hit real estate prices is if all the other major banks started failing, and specifically all of their mortgages they were holding started failing, which was a repeat of 2008. That's when that scenario would kind of play out and actually hit real estate prices. So that would kind of be the worst case scenario. And again, it's looking like that's not going to happen. But the positive to this is that clearly the interest rate hikes are finally hitting the economy. That lag effect that we're seeing is finally hitting just now. And with this bank kind of going under, it's signaling to the Fed that, hey, your interest rate increases are working. Don't go go too crazy just yet because this is possibly just the beginning of a crapshoot kind of hitting maybe all of the other banks. Maybe it's time to slow down the rate hikes and possibly even start cutting rates a little sooner than they are projecting, which was Q1, Q2 of 2024. That might be moved up to September, October, December maybe of 2023, which if we start cutting rates, that is very, very good for real estate prices. Think of it this way, it's more of a supply and demand thing. If the rates start coming down, that's gonna allow people to get into the market and have a lower mortgage payment, which is what we've seen for the past year of why people really aren't buying real estate anymore. It's because those interest rates are too damn high. But if the Fed is forced to start cutting them because we're heading to an economic recession, that's gonna be very, very good for real estate. And with the bond yields and bond rates falling on Friday insanely, like 5% across the board on 10-year and 30-year treasuries, that's, again, that alone is really, really good for real estate as well because it's lowering those long-term mortgage rates. Now, if that was too technical and went way over your head, I'm gonna break it down super easy. So basically, all you wanna pay attention to is the 10-year bond rate. If that rate starts going up or down, the 10-year directly correlates to long-term lending in residential mortgages. So whatever that 10-year bond rate does, long-term mortgage rates also follow. So if those start falling, mortgage rates start falling, which on Friday, after this whole debacle, the 10-year dropped 5%, which is a lot. Like it fell 50 basis points from last week alone. That's 0.5% if you don't know what basis points means. That's a lot. And that's because people now are starting to get a little freaked out about a possible recession, which we kind of always knew was going to happen on this channel if you're following, but now it seems like it's going to be a little more of a harder landing. So more people are fleeing to bonds, which is, again, the most secure asset you could really ever buy, like I said, because you're betting on Team America, which they're never going down. So when you have a bunch of people running to buy bonds because they're terrified of a recession, that's gonna lower bond prices. When nobody wants to buy bonds, which is what we've seen in 2020, 21, and especially 2022, because the stock market is doing so friggin' well. Like, why would I buy a 3% treasury when I can bet on Facebook, which is probably gonna go up 3% in 2 days? You know what I mean? So when we have markets like that, people want to invest in the stock market rather than the bond market because they don't fear a recession. Well, now people are really starting to fear a recession. And the third thing to think about when it comes to real estate prices and how this is going to affect real estate is, I've said this many times on my channel and I've shown so much data on this, is that we can have an economic recession, but it doesn't always mean you're also going to have a real estate recession. So if you look back to the late 80s, stock market crash, real estate, kind of stayed flat, it puttered along, it did its thing, and then in the 90s, it really started catching up and going a lot higher. So we had an economic recession, people losing their jobs, high interest rates, stock market went super down, but real estate just kind of did its thing and then started going up again. Typical boring real estate. In the 2001 dot-com bubble, we had a massive stock market crash, some economic, downturn and worries. Real estate, again, kind of stayed flat, did its thing. 2008, that was a direct real estate specific mortgage crisis. So real estate prices went way down because everybody had to sell their homes, sell their mortgages at a huge loss. So there's a ton of supply on the market. Nobody wanted to buy at all. So we had no buyers, lots of supply, thus prices are going to fall. In the mini recession of 2020, which lasted like 2 weeks, stock market went down crazy. Real estate prices shot up like insane over that year. And what we're seeing now at the start of 2022, when the interest rate cycle started happening, we haven't really had an economic recession just yet. I think we're starting to see those cracks now, all those job losses we're hearing about. But real estate, in my opinion, has been in a recession already for like almost a whole year now. So we've been in a real estate recession, and the economic recession we're feeling is like just about to start now. But a lot of smart economists and real estate experts think that the real estate recession we're currently in is very, very, very close to the end, if not, especially with what just happened on Friday, the end, the bottom, because it's signaling to the Fed, hey, you're going way too fast. It's probably a good idea to slow down or even pause, and you're probably gonna have to start lowering rates sooner than you thought, which again is super, super good for real estate prices. So we might have real estate coming out of a recession and the economic recession just starting, and that's typical, that's how it works. It happens so many times throughout history where you have an economic recession, doesn't always mean you have a real estate recession, and vice versa. They don't always have to happen at the exact same time, or at the exact same intensity. So what does this all mean? It means keep buying quality real estate in quality areas. Don't change what you're doing. Keep staying conservative on what you're buying. But if you're buying in good areas, which I always talk about on my channel, which is areas that have good GDP growth, because it always leads to good job growth, which always leads to good population growth, which will always automatically lead to an increase in rental and real estate prices. That's how real estate works. So if you're buying in those type of areas, which by the way, there's a ton of them, especially in states like Florida, like Texas, more of those kind of red Republican states where the GDP growth is amazing. People are moving constantly, daily, like it's insane. There's so many jobs. Real estate is in demand. There's not enough real estate and there's more people looking to move and buy real estate. Those are the areas that you want to focus on. And for example, where I am right now, we're in South Florida, Naples area. This particular area hasn't seen any decline in real estate, which is absolutely mind-boggling since this whole interest rate hike started. It's one of the only places in the country where real estate is keeping on doing its thing, but it's projected it's just gonna keep on doing its thing because it's supply and demand. There's not enough houses here for the amount of population and the people moving in, and there's tons of jobs, there's tons of activity, things are happening, things are rolling. So if you keep investing in areas like that, no matter what the economy is doing, and you have a 5-year plan minimum to hold this real estate and hold it out and wait for time to do its thing, you're gonna be very, very successful. So with all of this noise, all of this fear, all of this, fear BS crap going on, which is fair and justified to pay attention to, it's really, really great for savvy real estate investors who know exactly what they're doing. They have systems, they know how to buy, they know how to renovate and get quality tenants and hold it. You're gonna do just friggin' fine. If not, really, really good. I think the next 5 years of real estate, if you start buying now and very soon, you're gonna do very, very, very well.